Good afternoon. It's Jeffrey Christian, CPM Group. It's about 12:45 p.m. on Tuesday, November 15th here in New York. I want to talk about investing in physical silver today. CPM Group advocates investors buy and hold a range of precious metals investments in a diversified precious metals portfolio. It's what we've always said since the 1980s, and it still is our situation. Different investments and different investment instruments have different functions in a portfolio. And when we say that we think that investors should own physical silver and gold and maybe other precious metals too, it doesn't mean that we don't think that they shouldn't invest in futures and options and ETFs or a range of silver mining company equities, from majors to middle-sized companies to exploration plays, because those instruments provide valuable investment criteria and characteristics that physical metals don't provide. But they're additive to the basic physical silver position. I would say if you're like me, you probably have a significant amount of silver in your personal investments. And if you're like me, your average acquisition price is less than $10 an ounce. You're probably not like me in that I've been an investor for a long time. If I have an average acquisition price below $10, you can look at a price chart and sort of see how long I've held that core silver position. That doesn't mean that I don't invest around it with additional physical metal or futures or options. I don't use ETFs, although some of my colleagues at CPM Group prefer ETFs and ETF options to futures and futures options than I do. And then a range of investment equities in silver mining equities. It all factors in. And this is the advice that we give our clients. And if we're managing assets for them, this is the way we manage their assets, is to have this diversified portfolio. But there's a core that is physical metal, gold and silver, which is one's wealth preservation. It's there as an insurance against catastrophes. Those catastrophes may be personal, loss of a job, loss of a spouse, physical illnesses, your house burns down, or they could be more generalized catastrophes that affect you, either regional or local or national or international. But a relatively small portion of your wealth should be in physical metal, given the probabilities of really bad things happening. And when I say relatively small portion, I'm not talking about 5%. I'll show you the allocations a little bit later. Another tranche should be in longer term investments, some of which would be physical metal, but these are things that you're saying, okay, I might trade in and out of over a 3 or a 5 or a 10-year period. It's more of an investment than it is an insurance policy. And then a third portion, which would be more opportunistic, more of a trading portfolio. And that would probably include futures, options, ETFs, and equities. And that's the way that we look at the world. It's the way we personally handle our wealth. And that's where it is. The reality is that physical metals provide characteristics that derivatives of physical metals don't. An ETF, a lot of people who own or invest or trade ETFs don't realize those are not metal. Those are shares in a company that owns metal. And there's no direct link between you owning those shares and you owning that metal. And it can be quite cumbersome and expensive to sell those shares and then buy the metal if you want to shift from owning ETF shares to owning physical metal. So a lot of people don't realize that when they're owning ETFs, they're not owning physical metal. We always say, if you want to own gold, buy gold. If you want to own silver, buy silver. Own physical metal. Some of it probably in your own possession or in secure close by locations, some of it in reputable non-bank depositories in your country and offshore. So have your metal physically in your name, typically unallocated or allocated, but in your name, in your title, available to you. And the reputable part is very important. We've seen companies that a lot of people thought were reputable disappear. The owner and his secretary and the client's metal take off for Hawaii. It's happened. People who profess to be profoundly religious and moral, people who were writing books on how God wants you to teach your children financial responsibility, doing that. There are people who are considered reputable by many people, retail investors in North America, that we won't do business with. There are people that are considered reputable that we don't consider reputable ourselves, but we still do business with them. And then there are those companies that we know, and we know the people who run them, and we feel comfortable with them. Those are reputable non-bank depositories. And it's very important to underline that reputable. We're seeing some crises in the cryptos over the next weeks, and I hope to talk about that later this week in another video. And they drive home the fact that when you have a paper asset, a derivative of silver or gold, you have a derivative and you have counterparty risk. And depending on what type of derivative it is, an ETF, you have counterparty risk with the operators, with the holding company that holds the metal, with the company that manages that, with the companies that trade the metal back in and out of that ETF. You don't have that with physical metal. So physical metal, coins, large bars, depending on who you are, actually is that core, that basis. It serves as an insurance against catastrophes, and it also serves as an investment. Futures, options, ETFs, equities, they're all additive to that position. I'm sorry if I'm repeating myself, but it seems like I have to. This is a standard, efficient frontier of portfolios with silver, going back to 1968 to 2019. This is silver's optimal role in a portfolio historically. Past performance is no indication of future performance, they always say. 2 lines here. The red line is a portfolio consisting of S&P 500, T-bills, and silver. And it starts where you see zeros, where there's no silver in there. And you can see in that red line that the risk, the horizontal scale, is around 5.5%. And the return is about 6.5%. As you add silver, the blue line is a similar portfolio, but instead of T-bills, T-bonds, so slightly higher returns. As you add silver, you increase both the risk and the returns in your metal, in your portfolio. This is a standard Ibbotson and Associates methodology of comparing what happens when you add a single asset to a standard conventional 50% S&P stocks, 50% treasuries portfolio. You add one asset at a time so that you can see what the effect of that asset is on a standardized, generalized portfolio. And the red line with T-bills, you can see around 25%. You have rising risk as you add the silver to it, your portfolio, but the return, the increases in the returns are greater than the return increases in risks. And at 25%, you have a greater return on average historically over the last 53 years, 54 years, than you have increase in risk. With the portfolio where you're using T-bonds instead of T-bills, it's closer to 30%. Now that's an astoundingly high level. I said earlier you should have a small portion of your portfolio in silver. This tells you that historically that optimal small amount would have been 25 to 30% of your portfolio. Most people don't do that. They don't have it that high, but clearly it's not 5% of your portfolio or 2% of your portfolio. It's something greater than that. Now, I've been asked to comment because somebody else, a marketing group, came out with a study recently that had a lower percentage. And you can see here, even at 5%, you're ahead of the game. And they had a lower percentage, but they did several things wrong. First off, they didn't go back over a full 54 years of history. They chose a shorter time period. They didn't use a standardized portfolio. They didn't use physical silver. This is physical silver. They used silver futures. And that was weird because when you look at the returns available on commodities, not just silver futures, but across commodities, if you look at the returns in futures, the bulk of the return is the interest you earn on your margin account. The second largest portion of your return on a commodities investment in futures is the roll from spot to nearby forward to forward every 2 to 3 months. And the smallest portion of your return is the actual capital appreciation on that commodity. We saw this in the mid-90s when Morgan Stanley commissioned a study that led to the whole concept of commodity supercycle. And the whole study was predicated on using commodities futures, which skewed the returns because it was mostly looking at high T-bill rates historically. But if you do it properly, you use a standard 50% stocks, 50% bonds, and then you add in 5% increments, physical metal, this is what you get. 25, 30% optimal portion historically over the last half century. Not saying that you should have 25 to 30% of your portfolio in silver, but that's what the numbers show. Now, similar portfolio with gold has about 25 to 30%. So you have some competitive aspect between gold and silver. And you might want to say, well, if I have 25% of my portfolio in precious metals, I divide a portion of that between silver and gold. Couple last charts. These are our intermediate term projections since we started keeping track in December of 1980. In December of 1980, our first recommendation was sell silver or go short even. You can see from 1980 through 2001, 2002, we were back and forth. Yeah, go long, go short, go long, go short. About 68% of the time, I think we were telling people, don't be long silver, be short it. 2002, 2001, we said go long. We were a few years ahead of time, but by 2005, the price started rising. You can see it didn't get over $10 an ounce until about 2007. Got very high in April of 2011 when the price touched $50, we said sell. And then we came back in 2019 and said go long. This is for investors with a 2 to 3 to 5 year time horizon, what we call intermediate term recommendations. And then these are the returns. If you had gone long in December of 1980, you would have an annualized return of about 0.2%. You'd be up about 58% from then as of April 2021, the last time we updated this. If you had just gone long when we said buy and gone into T-bills when we said sell, you'd have about 11.7%. And if you had gone long when we said long and short when we said short, you'd be about 18% return. A lot of this is available in previous videos. You will see that you might have noticed on 2 of the slides that I excerpted slides from a 2021 video that we did. A lot of it's available on our website, and you can go to our website and read all kinds of other things. You can order our yearbooks on silver, gold, and platinum group metals. You can sign up as a retail investment client and receive more current and short-term things, including short-term gold and silver trade recommendations. And you can read all about precious metals. Thank you. I'll talk to you later in the week. Take care of yourself.